Hey everybody, it's me, Gregory Mannarino. How are you today? It is Monday, January 29th, 2018. People, the bond market right now is in a lot of trouble. It literally fell off of a cliff, and I am not kidding. If you don't believe me, if you think I'm exaggerating here, just go to my website, traderschoice.net, and have a look at the chart there. It's free. You have nothing to lose just by going to have a look. Right side of the page under the chat room. I mean straight down. What is this doing? Well, yields are rising. The U.S. 10-year yield is over 2.7. Okay, in the grand scheme of things historically, not bad whatsoever. However, these are not normal times. This market has relied heavily on suppressed interest rates to continue to rise. This is the mechanism the Federal Reserve has put in place. More importantly, maybe, we got these rising rates here, and now the spread, or the difference between the 10-year and the 30 is now 24 basis points, flattening out that yield curve even further. So there's a couple of dynamics in this market that are not good for stocks, and right now, stocks are under pressure. Not a lot of pressure, but they're under some pressure. The market is trying to digest what is going on here. Now, what we have seen, you and I, over the course of the multiple months is the banks here and the Federal Reserve, because that's who's doing it, gets in here and starts buying up those bonds, keeping those rates down. The market is heavily relying and dependent upon this mechanism continuing to go on. So what I'm going to do here is nothing. I am going to watch that bond market. When I see, if it happens, which, again, I don't want to sound too, complacent here, because I think that's what the market is. It's extremely, nonchalant about this, because it realizes that the Federal Reserve and the banks have got to stabilize the bond market. It's priority number one. Again, the debt is in the largest bubble the world has ever seen, and it is honestly the greatest threat to human life on the planet. I've went over this before. If that bond market bubble, the debt market bubble bursts, we will face a resource problem that will create a problem that is biblical around the world. Again, the mechanism of continually borrowing cash from the future in greater and greater amounts just to sustain where we are is 100% dependent on what's happening in the debt market. It must be propped up at all costs. Of course, we do realize that at one point, no matter how much they try to prop it up, it will be the market that determines fair value. If world central banks were to get in here and continue to just buy everything, it will dilute the value of the currency. And again, we will face a moment here of inflation that is going to blow people's minds and lead to, unfortunately, a lot of people, millions, tens of millions around the world losing their lives because of this mechanism. Now, that's the reason why the world central banks cannot allow a real sell-off here to get going here in the bond market. So we need to keep an eye on this, and I mean big time. So go look at that chart on my website, traderschoice.net. Again, you should be watching these videos right on my website so you can look at the charts as I am talking to you. It's very simple. The dollar is a little bit higher today. This is putting pressure on metals. We know this mechanism. We've seen it before. The price action of metals is not real. I hate talking about it. You all know that. So what we do here as people that want to take advantage of this market here, or at least not let it kill us, is we sit back and we watch. Forget the stock market. Now, if you were to turn on CNBC or Bloomberg, they're going to just gloss over what is happening in the bond market right now. They're going to distract you with how earnings are coming in really, really good. Again, this is the mechanism here. They cannot have you focus on what's important. Look here. Look here. Do not look here. That's what they always do. This is how they keep people in line. And there's another thing going on I want to talk about real quick. The action in the stock market that we see is mostly driven by algorithms based upon certain parameters. If those parameters change, and they are changing with what's occurring in the bond market, unless they get back in here and start propping that up, the whole model that they're using for these algorithms can be thrown out in the garbage. So understand there's another thing that's going on here that we have to watch. At one point, that model will not work anymore. So that's a danger zone too. So again, the bond market, people, is in a lot of trouble right now. If rates continue to rise at the pace that they're rising now, the stock market will, without any doubt, suffer. So we need to sit back, keep our eye on this, forget the stinking Dow Jones Industrial Average, because that's all the Confederacy of Dunces want you to look at. Okay? It's the bond market that dictates value for every single other asset. So, again, don't underestimate the power here of the bond market to cause or wreak havoc across the spectrum of asset classes, unless, of course, once again, they get in here and prop it up. They have got no choice. That's the truth, but they're going to lose control at one point. Could it be today? Could be. Could be at any time. Because, again, nothing here is real. I will see you at the end of the day. We're going to sum all this up. And if I see them start propping up that bond market and stocks start to respond in a positive way, which is what I believe a lot of traders are looking for as well, I will enter a position or two at that time, and I will post it all over my social networks in real time if you want to follow along with me. All right, with that said, see you at the end of the day. Over and out.